Taxes may seem boring or intimidating, but they can actually be really exciting when you learn how to avoid them. Taxes are one of the largest fees you'll pay as an investor. Avoiding taxes isn't just reserved to the very wealthy, and there are many legal ways to avoid taxes. There are different strategies that can have a six-figure impact for the average investor. Learning these strategies and applying them is key to building your wealth. In this video, I will explain 5 steps which you can use to improve the tax efficiency of your portfolio and boost the after-tax returns. My name is Nick Doyle. Welcome to my channel where I talk about making money, investing, and achieving financial independence. I've been on the path to financial independence for about 5 years now. I started knowing little to nothing about investing and have gone to building over a 6-figure portfolio that generates more than $20,000 a year in passive income. My channel is about sharing my journey and knowledge with you to help you achieve your financial goals. If you're new to my channel, don't forget to subscribe and like this video if you find it useful. While the basics of investing are actually pretty simple, taxes can be one of the most complex aspects of investing. I'm going to do my best to break it down for you. Before we get into the details, everyone's situation is different. I am going to be covering the basics, and I am not a CPA, so make sure you double check all this information and double check with a CPA if needed. Let's talk about tax-efficient investing. Governments around the world want to incentivize their citizens to invest and save for retirement. So they've created laws that treat different types of investments differently, and then also created different types of accounts in which you can invest. And these different types of accounts also have different tax treatment. Tax-efficient investing is simply combining this knowledge and using the right types of investments and the right types of accounts to lower the overall amount of taxes you have to pay. So let's take a look at what the different types of investments are and the different types of investment accounts. So let's talk about the different types of asset classes, which are just broad categories of investments which have different tax rates. You'd have US stocks, you could have international stocks, you could have bonds, you'd have real estate, you could also invest in real estate investment trusts. Pretty much all of these asset classes are taxed a little differently. Now let's talk about the different types of investment accounts. First are tax-deferred accounts. These are accounts where the government will let you avoid paying taxes on your income now if you invest them in a tax-deferred account. The benefit is it gets to grow tax-free, and then you don't have to pay taxes until you're taking money out of the account. This could be advantageous if you're in a high tax bracket now and you will be in a lower tax bracket later. Some examples of these are a traditional 401k, a traditional IRA, or a simple IRA. The next category are tax-free accounts. Now you don't get to avoid taxes on your income now, you have to pay the taxes. But once you place the money in a tax-free account, it can grow tax-free and you don't have to pay taxes on it when the money's coming out in retirement. Some examples of these accounts are the Roth IRA or the Roth 401k. The third type of account is a taxable account. This type of account can be a little confusing because it's called a taxable account. It's really just like a regular checking account or brokerage account, and it has no tax benefits. You don't get to avoid taxes putting money in, and you also don't get to avoid money on the growth. So if your investments double or pay dividends or interest, you owe taxes on that. This is why it's called a taxable account, because you get no tax benefit. I made another video that goes into many more details about these types of accounts and helps give guidelines on how to prioritize investing in these different accounts. It also talks about the HSA, which is the ultimate retirement account, as it's basically both a tax-free and tax-deferred account. If you haven't seen that video, you need to watch it. The key to avoiding taxes is understanding how to combine the tax efficiency, the different asset classes, with the different accounts. This is one area where individual considerations are the most important. You will need to do your own research on which accounts are available to you and match those to your investment needs. The TaxAdvantage accounts have yearly contribution limits. If you aren't maxing out these accounts and reaching the limits every year, it's probably best for you to take advantage of these TaxAdvantage accounts and max them out. My other video is best suited for understanding the trade-offs between the tax-deferred and tax-free investment accounts, and which one you might want to prioritize if you aren't maxing both out. If you're like me and you're lucky enough to be able to max out all of these TaxAdvantage accounts, then you're left with investing in a taxable account. A couple of the following steps we're going to discuss don't quite apply if you aren't investing in a taxable account, and I'll mention this at each step. However, you still want to learn the fundamentals of all of these steps, as your income may grow to where you need to use taxable accounts, or when you shift into retirement, you can no longer contribute to TaxAdvantage accounts, so you might be forced to use taxable accounts in retirement. Here are the 5 steps for tax-efficient placement of the different asset classes. The first is you need to understand the tax efficiency of each of these asset classes. In my example, I will be covering the 3-fund portfolio specifically, which I believe to be the best portfolio for the average investor. I made another video on this called Asset Allocation, the 3-fund portfolio, which goes into this in more detail. You can see the tax efficiency of various asset classes in this diagram from bogleheads.org. Stock index funds are very tax efficient. They have special long-term capital gains and dividend tax rates that make them some of the most attractive investments for tax efficiency. As you move down, that tax efficiency gets worse. You might have intermediate term bonds, high yield bonds, or other asset classes like real estate investment trusts. All of these make regular distributions to investors that are taxed as ordinary income in your typical tax bracket. They are much less efficient than stock indexes. The second step is to place your least tax efficient investments into accounts first. You want to put these investments in TaxAdvantage accounts to allow them to grow for years without paying taxes. You might as well take advantage of that tax-free growth with the least tax-efficient asset classes. This is especially true with real estate investment trusts or higher yield bonds. When you get into lower yielding bonds, this is actually a source of disagreement with a lot of investors right now. Since bond interest rates are so low, they produce almost no income. So therefore, you barely pay any taxes on them anyways. Some investors may actually prefer to keep bonds in their taxable account since they're paying almost no taxes anyways. However, I choose to keep my bonds in TaxAdvantage accounts for 2 reasons. The first is that I am in a high tax bracket. Even if I were to keep bonds in a taxable account, I would still pay more in overall taxes at the low interest rates than I would by holding stocks in the taxable account. The second reason is I expect the lowest growth from my bonds. When I ultimately withdraw money from my tax-deferred account, I will have to pay taxes on it. And in fact, the government forces you to take yearly minimum distributions from these tax-deferred accounts once you reach retirement. These distributions are based on your life expectancy because the government wants you to pay taxes on all this money you've accumulated in the tax-deferred account before you die. I'd rather keep my lower growth investments in a tax-deferred account so they don't grow too large. By controlling the growth of this account, I'll have more control over how I pay taxes in the future. So as an example, with the 3-fund portfolio, you would take your total market bond index fund and first try to place it in your tax-deferred accounts. This is if your traditional 401k or traditional IRA has a good option for a total bond index fund. You could alternatively put this in the tax-free account if you don't have a good available choice in the tax-deferred account. The third step is to place your international stock index funds into a taxable account if you are investing in a taxable account. International stocks are a little less efficient than US stocks because the dividend tax rate is actually for qualified dividends, and these are a special type of dividend that qualify for the lower tax rate. While US stocks are nearly all qualified dividends, international stocks are typically maybe only 75% qualified. This means you pay a little extra in taxes on non-qualified dividends from the international stocks. But if you put international stocks in a taxable account, you get to take advantage of a foreign tax credit. Since your international index fund will have to pay foreign governments taxes on its investment earnings, you get to claim your portion of those taxes paid as a foreign tax credit on your US taxes. So this just means you get to reduce the amount of taxes you owe the US government by the amount of money that your index fund paid foreign governments on your behalf. This is to avoid double taxation. The US government is at least kind enough to say, hey, you already paid the foreign government taxes, so we aren't going to make you pay it here. Now, you only get to do this if you hold the international stocks in a taxable account. If they're in a tax-deferred or tax-free account, you do not get to claim the foreign tax credit. Again, if you aren't maxing out tax-deferred or tax-free investment accounts, this probably doesn't apply to you. It would probably make more sense for you to hold your international stocks in a tax-advantaged account because the tax benefits of the tax-advantaged account will likely be greater than the foreign tax credit. However, if you're investing in the taxable account anyways, it probably makes sense to hold your international stocks there. The fourth step is to place your highest growth investments in the tax-free accounts. We want our highest growth investments to be in the tax-free accounts since they're expected to grow the most. By being in the tax-free account, we get to avoid taxes on all of that growth, and we don't have to pay taxes if we sell them. Whereas you don't get that benefit in the tax-deferred account because whatever that money grows to, you have to pay taxes on it when you sell it and take it out. And the same goes for the taxable account. You have to pay taxes on all the dividends they might produce, and then when you sell them, you have to pay capital gains taxes. So by putting your highest growth investments in the tax-free account, you get to take advantage of all of that tax-free growth and the tax-free withdrawals. And the fifth step is to place all of your other investments last. At this point, we're pretty much left with tax-efficient funds, since the second step was placing all the tax-inefficient funds first. So once we've optimized our other steps, the tax-inefficient funds, the international stock index, and the high growth funds, we can place the remainder across all the rest of our accounts. At this point, we're not really optimizing for anything as these are already tax-efficient investments anyways. We're just placing them last so we get to take advantage of all the other benefits. So that's it. Those are the 5 steps you can take to boost the after-tax return of your portfolio by avoiding as many taxes as possible. Just remember to double check all of this information and consult a CPA if needed before applying this in your portfolio. The most important aspect of tax-efficient investing is choosing the right types of accounts to prioritize your investments. If you aren't maxing out all the accounts, you need to choose which ones you contribute to. My other video on traditional versus Roth versus HSA goes into far more detail and provides guidelines on how to prioritize investments if you aren't maxing out these accounts. Only if you already have multiple of these types of accounts do these types of fund placements make the most sense. In your scenario, if it only makes sense to have a tax-deferred account, then it could be fine just to leave all of your investments in that one account. However, other people will have all different types of accounts: the tax-deferred, the tax-free, the HSA, a taxable account, and that's where applying these 5 steps is very important. Almost nothing makes me happier than avoiding taxes, and I hope this video helps you avoid taxes. Thanks for watching, everyone. Please comment below with your strategies for avoiding taxes. And again, if you enjoyed this video and learned something from it, please smash the like button and then subscribe so that my future content lands in your inbox. Later.